私どもを取り巻く環境は極めて厳しく。
Управление допингом дешевых денег и проблемы с ипотекой в Соединенных Штатах Америки породили настоящую.
Okay, so imagine this. You're watching a movie sequel. Same director, same actors, same plot, but with better special effects and a bigger budget. That's basically what happened to the American financial system after 2008. Because while everyone was focused on fixing the banks, something else was quietly growing in the shadows. Something that's now worth over $1.1 trillion. Something that owns your kid's daycare, your local newspaper, and maybe even the company you work for. It's called private equity. And it's using the exact same playbook that crashed the economy in 2008. Except this time they've gotten really, really good at it.
It was the worst day on Wall Street since the crash of 1987.
So let's start with what actually happened after 2008. Everyone thinks the big bad banks learned their lesson, right? Wrong. They just evolved, like financial dinosaurs adapting to survive. Here's what's wild. In 2024, private equity deal value grew 19% year over year, hitting $838.5 billion. That's approaching the size of entire countries' GDPs. But here's the thing that'll blow your mind: the mechanics are identical to 2008. Same leverage, same risk, same profits now, consequences later mentality. Let me show you how this works, because once you see it, you can't unsee it. Okay, so imagine I want to buy this Lego house that costs $100, but I only have $20 in my pocket. So I go to a bank and say, hey, can you lend me $80? And they're like, sure, but who's going to pay us back? Oh, the house will pay you back. That's a leveraged buyout. I buy something with borrowed money, but the thing I'm buying is responsible for the debt. Over the last decade, global buyout companies had an average leverage ratio of 1.74. That means for every dollar they put in, they borrow $1.74. But here's where it gets truly insane. After I buy the Lego house with borrowed money, I go back to the bank and say, hey, can the house borrow even more money? What for? To pay me. That's called a special dividend, and it's completely legal. Let me tell you the story of Jeffrey the giraffe, because this isn't just about numbers. It's about 33,000 real people who lost their jobs. 2005, private equity firms buy ToysRUs for $6.6 billion using mostly borrowed money. 2007, those same firms pay themselves $470 million in special dividends, money borrowed against ToysRUs. 2017, ToysRUs files for bankruptcy, crushed by debt it never chose to take on.
$30,000 workers are losing their jobs.
The whole company is going to liquidate.
Now, my understanding is that financially, ToysRUs was actually doing fairly well. Is that the case?
Yes. They walk away with all this money, and hardworking, loyal, dedicated people are left with nothing.
The private equity firms walked away with nearly $500 million. The workers got severance packages that never came. And that's not a bug in the system. That's literally how it's designed to work.
We deserve to have the severance pay, and we need to change the rules so that bankruptcy laws in this country are not designed to benefit those who already have billions of dollars, but to benefit the everyday workers that do not have people fighting for them.
Now, if you lived through 2008, you probably remember something called CDOs, collateralized debt obligations. Banks packaged risky mortgages together and sold them as safe investments. Well, guess what's back? They're called CLOs now, collateralized loan obligations. The CLO market has grown impressively, reaching about $1.1 trillion in assets with over $100 billion in new issuances annually in 2023 and 2024. It's the exact same recipe. Take risky private equity debt, bundle it together, label the top layer AAA safe, sell it to pension funds and insurance companies. It's literally the same fish, just with a new wrapper.
Okay, I'm a chef on a Sunday afternoon, setting the menu at a big restaurant. I ordered my fish on Friday, which is the mortgage bond that Michael Burry shorted. But some of the fresh fish doesn't sell. I don't know why. Maybe it just came out halibut has the intelligence of a dolphin. So what am I going to do? Throw all this unsold fish, which is the BBB level of the bond, in the garbage and take the loss? No way. Being the crafty and morally onerous chef that I am, whatever crappy levels of the bond I don't sell, I throw into a seafood stew. See, it's not old fish. It's a whole new thing. And the best part is they're eating 3-day-old halibut. That is a CDO.
Lenders like Angelo Mozillo really didn't care if people ever paid their mortgages because those loans did not stay on the mortgage company's books. Mortgages were bundled together with other loans from across the country and moved to Wall Street. There, they were packaged up into complex new financial products. Bankers went wild for these financial securities that were really just stacks of IOUs. There was almost no government regulation of this market. It became a massive system of buying and selling these IOUs, with fees being charged on each transaction.
It was just all a way to make fees and to package up these streams of supposed cash flows and sell them off to investors. I mean, for a while there, anybody who touched a mortgage made money. It was like the most perfect product.
Now, here's where things get really spicy. For over a decade, interest rates were basically zero. Private equity firms could borrow money for almost nothing. But then 2022 happened. Rates went from 0% to over 5% in just 2 years. Remember those adjustable rate loans? Nearly $270 billion of leveraged loans carry weak credit profiles and are potentially at risk of default, according to Fitch Ratings. When your debt payments triple overnight, things get very ugly very quickly. But wait, there's more. More than $620 billion in high-yield bonds and leveraged loans are set to approach maturity in 2026 to 2027. That's called the maturity wall, and it's basically a financial cliff. Imagine a highway where all the bridges are missing in 2027. That's what the debt market looks like right now. Companies need to either, 1, pay back their loans impossible. 2, get new loans to cover the old ones, good luck with 5% plus interest rates. 3, go bankrupt. Guess which one most are choosing? Now, you might be thinking, so what? Rich people lose money? Who cares? But here's the thing, it's not rich people who get hurt. PSP tracked 1049 private equity-backed healthcare deals in the United States in 2024 alone. We're talking about your local hospital, your kid's daycare, the nursing home, even your veterinarian. When these companies collapse, it's not the private equity executives who lose their jobs. It's the nurses, the teachers, the veterinary technicians. 12 million Americans work for private equity-owned companies. When the dominoes fall, they fall first.
Right now, there's this trend happening. Oregon just banned it, which is great. But we need like a nationwide policy that prevents private equity firms from buying up.
Yeah, that's going to go bad.
They're buying public hospitals, nonprofit hospitals. And when they do that, they introduce a profit motive into those hospitals, and they ensure that it's as efficient as possible so they can maximize profits, so doctors don't get to spend enough time with their patients, and it just kind of becomes like a factory, like
I
move
can
them
tell
out.
you stories that would blow your mind if we have time, because I worked in a for-profit hospital, and the problem, again, wasn't the for-profit hospital, it was the insurance companies.
So why hasn't this been stopped? Simple. The people writing the rules are the same people profiting from breaking them. Jay Clayton used to run the SEC, literally the agency that's supposed to regulate Wall Street. Today, he works for Apollo, one of the largest private equity firms in the world. Private equity firms donated nearly $300 million during the last election cycle. Both Democrats and Republicans cashed those checks. They're protecting something called carried interest, a tax loophole that lets billionaire fund managers pay 20% taxes instead of 37%. That's billions in lost tax revenue every year.
Carried interest. First, it's got nothing to do with carrying interest from year to year. The term dates back to 16th century Italy. A ship captain would transport cargo and take a 20% cut or whatever they carried. Fast forward to now. An investor pours money into an investment fund, such as a private equity firm, and that private equity firm makes money, usually in the multi-millions. A big chunk of that money goes back to the investor. But like the ship captains, 20% goes back to the fund manager. That 20% is carried interest. The managers pay 23.8% taxes on that money, 20% capital gains, and 3.8% investment tax. And that's how it should be, according to those who view hedge fund managers as entrepreneurs.
Private equity loves to say they're improving companies, but let's look at the data. Almost 1/3 of U.S. buyout-backed companies have been held for 5+ years, way longer than the typical 3-5 year hold period they promise. Why? Because they can't find buyers. The companies are too loaded with debt. Nearly $270 billion of leveraged loans carry weak credit profiles and are potentially at risk of default. Meanwhile, secondary PE trades hit a record in 2024, reaching over $150 billion. That's firms desperately trying to get rid of their investments. The smart money's heading for the exits. Look, I'm not here to be an alarmist, but the math is the math. Global private markets navigated uncertain conditions in 2024, leading to an uneven recovery across different asset classes. Translation, the cracks are showing. Will this destroy the entire economy like 2008? Probably not. Will it hurt millions of working Americans while the people who created the mess walk away rich? Absolutely. The difference between 2008 and now is that in 2008, some people saw it coming and bet against the system. This time, you get to see it coming. Here's what I want you to remember. Ignorance isn't neutral. It's dangerous. Every time someone says private equity is just capitalism, you now know better. Every time a politician talks about creating jobs while taking private equity money, you now know what to look for. Every time a company you care about gets bought by a financial sponsor, you now know what probably happens next. Because the thing about power is this, it only works when people don't understand how it works. But now you do.